Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
Okay, let's just get right to it. Yesterday, January 21, 2026, RMBS Inc. closed at $125.93. That's a single-day gain of 14.38%, just $15.83 added in one session.
And the volume was huge.
Heavy, 5.9 million shares, and it didn't even stop at the bell. And after hours, the stock pushed up again. I saw it touch 132.
We have to contextualize that number, though, immediately. This wasn't just a good day. This was the exorcism of a 26-year-old ghost. The old all-time high for RMBS was $117 set way back in June of 2000.
The absolute peak of the dot-com bubble.
Exactly. The peak. For more than 2 decades, that price has been this, iron ceiling. And yesterday, RMBS didn't just break it, it shattered it. But while the chart watchers are screaming breakout, I'm looking at the fundamentals and I see a stock that is suddenly, and I mean suddenly, priced for absolute perfection.
See, I'd frame it differently. I don't see price for perfection. I see a stock that is finally being priced for its reality. The market has finally woken up to the fact that RMBS isn't that litigious patent troll from the early 2000s that everyone remembers. It's transformed. It's now the toll booth for the entire AI economy. This breakout is a fundamental re-rating, and it's driven by what people are calling the memory supercycle.
I just come at it from a completely different angle. I see a company with a market cap getting close to $12 billion, trading at nearly 60 times earnings, while the very people running the company, directors like Nekip Sioner and Emiko Higashi, were selling stock hand over fist just a few months ago. They were selling between $66 and $78. So if the insiders didn't see the value at 70, I have a very hard time justifying why anyone should be chasing it at 126.
Let's dig into that, because I think you're looking at the past while the market is pricing the future. My position is pretty simple. We are entering the memory wall era. We have plenty of GPU compute. You can buy H100s, you can get Blackwells. The problem, the real constraint, is moving data between those units. Physics has become the bottleneck.
And you think RMBS solves physics?
Yeah. Well, they solve the efficiency of the interface, which is the next best thing. I mean, just look at the capital expenditure guidance from TSMC. They just announced a CapEx plan of $52 to $56 billion for 2026.
It's a staggering number.
It is, and it's not for building legacy chips. This is for what they call Foundry 2.0, advanced packaging, 2-nanometer nodes, CoWoS, and every single AI accelerator that comes out of that process. It requires a proportional ecosystem of high-speed memory interfaces. Those are the RCDs, the register clock drivers, and data buffers that RMBS sells. You literally cannot deploy a Blackwell GPU without this plumbing.
Okay, look, I'm not disputing the utility of the product. The chips are necessary, absolutely. My skepticism is entirely focused on the valuation placed on that utility. You mentioned TSMC, which is arguably the most important company in the world right now, and yet it trades at a pretty reasonable multiple given its dominance. But RMBS? Depending on whose estimates you use, we're looking at a PE ratio between, 51.8 and 59.2.
Right.
The historical median for this sector is vastly lower, usually in the 20s. So you are asking investors to pay a premium that leaves zero, and I mean zero, room for error.
But the premium exists because of scarcity. SK Hynix has reportedly raised DDR5 prices by 15 to 20%. HBM, high bandwidth memory, is completely sold out for the year. Samsung and Micron are scrambling to catch up. So when the commodity itself, the memory, is scarce and getting more expensive, the interface chips that control it gain immense pricing power. RMBS can raise their ASPs without any pushback because they're a tiny fraction of the total server bill of materials, yet the server doesn't work without them. It is the definition of inelastic demand.
That is a compelling point on pricing power, I'll grant you. But have you considered the smart money signal? I mentioned the insiders earlier, and I really want to double down on this because it bothers me. August and September of 2025, directors Nichip Sainer, Amiko Hagashi, Stephen Laub, all active sellers, unloading shares in that $66 to $78 range. These aren't low-level managers. These are directors with a fiduciary view of the company's entire roadmap. If this memory supercycle is so obvious, why were they cashing out at prices 40% lower than where we are today?
Well, insiders sell for all sorts of reasons. Tax planning, diversification, buying a house, whatever. It's often just noise from their stock-based comp vesting. But look at who is buying. Institutional ownership is locked at 93.89%.
That is effectively a cornered market. T. Rowe Price and BlackRock have been accumulating. So when you have 94% of the float locked up by long-term asset managers who aren't day trading, the available supply for trading is incredibly thin. That's why we saw a 14% move on just 5.9 million shares. It's a supply shock. The float is gone.
A supply shock works both ways, though. If those institutions decide the valuation has gotten ahead of itself and start to trim, there's no retail base large enough to absorb that paper. But let's stay on this valuation point, because I think it's the crux of our disagreement. We have to talk about what kind of company Rhombus actually is. Is it a hardware company or is it an IP company?
Exactly. This is the valuation paradigm debate.
Right. So if you treat Rhombus as a semiconductor products company, which, by the way, is where they get the bulk of their revenue from selling physical chips, the valuation is just absurd. Look at Marvell Technology, MRVL, massive infrastructure player, data centers, optical, a great company. Marvell trades at roughly 28 times earnings. Rhombus is trading at double that. If Rhombus is just a hardware maker, it is wildly expensive. If execution falters for even a second, this stock reverts to a hardware multiple, which would put it right back in the $50 to $60 range.
I'm just not convinced by that line of reasoning, because it ignores the business model shift. You can't compare Rhombus to Marvell anymore. You have to look at the IP premium. Rhombus is pivoting hard toward high-margin IP licensing, specifically for HBM3, HBM4, and CXL, Compute Express Link. They're becoming more like Synopsys or Cadence.
Synopsys and Cadence are software monopolies. They're basically SaaS businesses for chip design.
They're EDA and IP giants, right. EDA is electronic design automation, the software used to design chips. And just look at their multiples. Cadence trades at 78 times earnings. Synopsys is at 64. The market is re-rating Rhombus because it realizes that as chip designs get more complex, the interface IP, the literal blueprints for how chips talk to each other, becomes as critical as the EDA tools. If you view Rhombus as an IP licensor for the AI era, a 60x multiple isn't expensive. It's actually a slight discount to Cadence.
But that's the trap. Cadence and Synopsys have recurring, sticky revenue from software subscriptions that are essential for every chip design. Rhombus still has to sell physical chips in a competitive market against companies like Montage Technology and Renesas. Their revenue is lumpier. They just had a quarter where they beat on revenue but missed on GAAP EPS by 44 cents. That doesn't look like the smooth, high-margin compounding of a Synopsys. It looks like a hardware company with execution issues.
That miss was accounting noise. It was related to acquisition costs and amortization. The revenue beat is what matters because it confirms the demand. But let's look under the hood at the market structure. You mentioned the volume yesterday. I'm looking at the off-exchange data. The dark pool short volume ratio is 48.72%.
Which sounds ominous to the average investor. Dark pool implies something nefarious is going on.
To the untrained eye, maybe, but in its context, it's bullish. Dark pools are just private exchanges where institutions trade to avoid moving the market price. So when nearly half the volume is happening off-exchange, it tells me that institutions, the whales, are buying. BlackRock isn't going to put a 100,000 share buy order on the NASDAQ limit book because it would just drive the price up before they could fill it. They use dark pools to mask accumulation. And that high off-exchange volume tells me smart money is trying to get in without slipping the price. But the demand is just so high they can't hide it anymore.
I see that data, but I interpret the short volume part differently. I look at the actual short interest. We have about 4.08 million shares short. It's roughly 4% of the float. It's not huge, I'll grant you that, but the days to cover is over 3.
3 days to cover is significant. It means if every short seller wanted to exit at once, it would take 3 full days of normal buying volume just to let them out.
It is. And I suspect yesterday's 14% rally wasn't just pure fundamental buying. I think it was a mini squeeze. When you break a 26-year high, every short who has been betting on a valuation mean reversion is suddenly underwater. They panic buy to cover. That adds fuel to the fire. My concern is that once that 4% of shorts are squeezed out, and they probably were yesterday, who is left to buy? You run out of incremental buyers.
I really don't think we're running out of buyers. I think we're seeing a new class of buyers emerging who are using alternative data. Have you looked at the correlation with Polymarket?
I keep an eye on it, but I'm skeptical of using betting markets to value equities. It feels a bit like using a horoscope to predict the weather.
You shouldn't be so dismissive. It's a second derivative indicator. Right now on Polymarket, there's a contract asking largest company by market cap at end of January. Traders are giving NVIDIA a 94% chance of retaining the top spot. The implied valuation is over $4.5 trillion.
Sure, NVIDIA is the king. We know this. But what does that have to do with Rambus trading at $126?
We'll just follow the logic. If the wisdom of the crowd says NVIDIA is worth $4.5 trillion, it implies a belief that NVIDIA is successfully shipping millions and millions of H100s and Blackwells. Physics dictates that those units require high bandwidth memory. They cannot function without it. So a bet all Rambus right now is essentially a leveraged beta bet on those Polymarket odds. If the market is 94% sure NVIDIA dominates, the market should be 94% sure that the memory supply chain is going to be fully utilized. Rambus is the proxy trade for people who think NVIDIA is too crowded but want exposure to the same volume growth.
That works in a bull market. Of course it does. But that high beta is exactly what worries me. You're describing a scenario where Rambus is tethered to NVIDIA sentiment. If that Polymarket probability drops, say we get a macro shock or the soft landing consensus breaks, Rambus has the furthest to fall. It's a high wire act. If NVIDIA sneezes, Rambus catches pneumonia because it's trading at 60 times earnings.
The macro backdrop is supportive, though. Polymarket also shows a consensus for a soft landing. Stable rates, growing GDP. It's the perfect environment for high-growth tech.
Let's bring this back to the immediate future. We can talk about 2028 and soft landings, but Rambus has earnings coming up February 2nd, 2026. That is less than 2 weeks away. It is a binary event.
It's a catalyst, certainly.
It's a danger zone. Consensus is looking for what? $712 million in annual revenue and non-GAAP EPS of roughly $1.72. The stock is at an all-time high. If they report in-line numbers, just meeting expectations, this stock sells off hard. When you're priced at perfection, good isn't good enough. They need a massive beat and raise. They need to guide Q1 2026 significantly higher to justify this price tag.
I think the memory supercycle protects them here. We know data centers are consuming 70% of all memory chips produced. The demand is inelastic. The hyperscalers, Google, Microsoft, Amazon, they aren't cutting CapEx, they're accelerating it. So the guidance should naturally reflect that. We are just looking for confirmation of accelerating DDR5 attach rates. As long as they confirm that, the floor holds.
But there's a long-term risk you're ignoring while you focus on this cycle. Obsolescence. You called Rambus the toll booth, but roads change. We are seeing massive innovation in optical and photonics interconnects from companies like IR Labs and even Marvel. There is a real possibility that post-2028, we move away from electrical interfaces entirely for these high-speed connections.
Explain the distinction for the listener.
Okay, so currently, Rambus works with copper electrical signals. But copper heats up and creates resistance at high speeds. Photonics uses light. It's faster and cooler. If the industry moves to light-based data transfer, Rambus's electrical patents become a lot less relevant.
That's a post-2028 problem. In the tech world, 3 years is an eternity. For right now, and for the next 24 months, copper and electrical interfaces are the only way to scale AI economically. Light is still way too expensive to deploy everywhere.
But the market is pricing this stock like it's a perpetuity. That's my issue. You're paying 60 times earnings for a technology, electrical memory interfaces that might get displaced by light.
I think that underestimates their ability to pivot, just as they pivoted from patent licensing to hardware. But let's look at the CXL opportunity. Compute Express Link is the future growth engine.
Break down CXL for me.
Think of a data center today. You have a CPU with its own memory and a GPU with its own memory. They are siloed. If the CPU needs more memory, it can't just borrow it from the GPU. CXL changes that. It allows different processors to share a giant pool of memory. It solves the stranded memory problem. Rambus has been acquiring assets heavily in this space. That's the next leg of the stool, and it extends the runway well past the current DDR5 cycle.
CXL is promising, I'll give you that, but it's still early innings. The revenue today is RCDs and data buffers, and today the stock is vertical.
It's a blue sky breakout. There is no overhead supply. There are no bag holders from 5 years ago waiting to sell at break even, because everyone is in profit. That is a powerful technical dynamic.
It's also a dynamic that invites vertigo. When everyone is in profit, everyone has a finger on the sell button, just waiting for the first sign of weakness to lock in those gains.
Okay, so let's summarize. Where do you really land on this?
I'm sorry, but I just don't buy the "this time is different" narrative enough to pay 60 times earnings. Breaking the dot-com high is impressive visually, but fundamentals matter. Insiders were selling at $70. To me, that is a screaming red flag. The easy money has been made. If you buy here at 126, you are betting on a perfect earnings report and a flawlessly executed roadmap. I think caution is required. The risk-reward just isn't there for me.
I see why you think that, but I believe you're missing the forest for the trees. The market is finally understanding the bottleneck. Rambus has transitioned from a sideshow to a critical utility. As long as the memory wall exists, and it's not going away anytime soon, the premium is justified. The shortage of HBM and the pricing power in DDR5 create a buffer that justifies the valuation. I think we are just seeing the beginning of the institutional repricing of this entire asset class.
Well, for the sake of the bulls, I hope the plumbing holds up.
And for the sake of the bears, I hope you haven't shorted into a blue sky breakout. So that's our deeper look at Rambus. The chart says one thing, the insiders say another. You have to decide if you're buying the IP story or the hardware reality.
Until next time, keep looking at the data.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.